Hi, hello, good morning. It's great to be with each of you. I'm Zach Smith, Embark's East Region Market President, and I'm joined with my co-host, Adam Olsen, Embark's Accounting Advisory Practice Leader. On this week's episode, we'll be discussing the recent rule made by the SEC regarding pay versus performance that companies will need to keep top of mind for their proxy filings. Adam, thanks so much for joining us.
Yeah, glad to be here.
So Adam, talk to me a little bit about the new pay versus performance. What should companies know about this recent rulemaking by the SEC?
Yeah, so the rule itself, it came out in kind of the Q3 of 2022. So the end of August last year, the SEC finally issued the final rule on pay versus performance, which at a high level, what it aims to do is basically for certain SEC registrants, they're now required to provide additional compensation disclosures about their executives' pay and how that relates to the company's performance, right? It's pay versus performance, so it's pretty straightforward for what it's looking to achieve. But the rule itself also created an additional item, so item 402B in Reg SK, and it more or less creates new disclosures that need to be added to proxy statements or other information statements where the company presents executive compensation disclosures.
Okay, so let's back up a little bit. Why did the SEC even issue this rule? What was some of the driving factors that we needed to have these additional executive compensation disclosures?
Yeah, the rule itself really kind of closed an existing mandate that was created under the Dodd-Frank Act, which basically said registrants need to disclose that relationship between how well a company's doing and what their executives make. And the genesis for why the SEC decided to create the rule as it's intended was we have to provide a framework that allows for information to be consistent, comparable, and give good decision useful basis for investors to understand a registrant's executive compensation policies. And it's actually, this rule's kind of been a long time coming. So back in 2015, they actually kind of put forth an initial rule. There was a comment period that occurred back in that day. And then it more or less kind of lost traction. And it wasn't until really early 2022 that the SEC kind of decided to kick up the initiative again and then moved very quickly by opening up another comment period and then ultimately coming up with the final rule. So kind of went for a sleep for a moment there, but they brought it back, and now it's effective starting with the 2023 proxy season.
Okay. Now, before we even get into any of the details about what specifically is required around this rule, Talk to me a little bit about who's actually impacted. Is it all SEC registrants?
So it's not. So the rule applies to registrants except for those that are considered emerging growth companies. So a benefit there, again, for emerging growth companies, registered investment companies, and then foreign private issuers. One thing to note is that smaller reporting companies, so SRCs, they are in scope of the rule. But they are afforded some kind of scaled down, more accommodated disclosures than regular registrants.
Okay. Now, speaking of disclosures, let's talk through some of the main requirements that companies need to release.
Yeah, there's three kind of major components that are made up of the rule. The biggest one is what's called the PVP table. So the pay versus performance table is the largest and most significant disclosure. And then in addition to that, there's this disclosure, which is referred to kind of in practice as the tabular list, which is just essentially like a list of financial performance measures. And then there's some more kind of qualitative narrative type disclosures where you would describe how the relationship works between what your executives pay and actually how the company performs. So each of those have their own kind of nuances and things you have to navigate through. But those are kind of the three main buckets of disclosures.
Okay. Well, let's go ahead and just start with the PVP table. Yep. Walk me through some of the highlights and requirements.
Yeah, so that table, essentially you've got to provide a 5-year table of pay versus performance. And it really can be kind of segregated between kind of two categories. You kind of have your pay-focused items on the table, and then you've got your performance-focused items on the table. So from a pay-focused area, you have to disclose total executive compensation that's reported in a company's summary compensation table, or SCT. And that needs to be for their principal executive officer, as well as the average total compensation for all of their other named executive officers, or NEOs. an additional paid kind of focused disclosure you have to make is the actual compensation paid. And that's both to the principal executive officer as well as the other named officers. And then the other side of the table is then looking at performance. So you kind of lay out your pay metrics there, and then next to it, you're going to have all your performance metrics. And so there's three kind of key performance metrics that are required. So one is a total shareholder return metric, and you have to provide that not only for the actual registrant themselves, but you also have to provide that same metric for that registrant's peer group as they define their peer group. And then in addition to that, you've got to include net income, very common financial metrics. So net income as it's presented in the financial statements. And then lastly, there's this one where companies kind of decide what is kind of the most significant company-specific metric to include. And so they'll include that company-specific selected financial measure as well in that table.
So Adam, you mentioned named executive officers that are included in this table. Who exactly qualifies as an NEO and to include in this average?
Yeah, so the named executive officers, it really kind of follows the definition that's outlined in item 402. And so generally this includes, you've obviously got your principal executive officer, but then in addition to that, you're going to have your principal financial officers, typically your CFO. And then you usually include the next three most highly compensated executives. And that, that would be other than obviously your CEO or CFO. But then the rule also provides that you can also include up to two additional non-executive individuals who also might be highly compensated. And so the average amounts that you would include for the disclosure would include all those individuals except for the principal executive officer, because they're already being disclosed as an individual in that table. And so this really just includes the remainder of that group.
Okay. So super helpful there. Let's talk about the two pay metrics that need to be included as well. Are there any of these that are already part of other disclosure requirements, or will they have to be derived?
Yeah, so the first one that kind of relates to the summary compensation table, that essentially comes from other SEC disclosure requirements. So you're kind of like lifting that one over more or less. But the real work actually comes around the next kind of pay focused disclosure, which is the total compensation actually paid. And that's generally something that most entities, at least how it's defined by the rule, aren't tracking currently. So it will be kind of a change in just like processes and policies and things like that to actually aggregate that information. And to determine that amount of that compensation actually paid, there's certain adjustments that are going to have to be made to kind of that summary compensation table. And they kind of relate to just kind of two key areas. So one's related to any pension benefits. And then probably the bigger one that most companies probably deal with more often is around equity awards. And the rule really outlines a lot of the specific adjustments you have to make to each of those items in order to arrive at that total compensation paid.
Okay, so obvious question. Why are these adjustments even necessary or needed?
I know. I think just to make things hard.
Yeah, that's what they like to do, right?
No. So the intent behind them, so like for the pension adjustments, for example, they're really kind of derived to ensure that the compensation actually paid reflects only those pension benefits that were earned during the year, and it kind of excludes other factors that might influence like pension amounts. So the adjustments kind of help negate like changes in interest rates and how that could impact compensation or other like actuarial inputs or assumptions that are made that might actually change that value. So really kind of honing in on what's actually earned by that particular officer or that group of officers. And then for equity awards, the amounts reported in your summary compensation table, they're basically based on kind of US GAAP accounting, which is going to be the fair value of the award at the grant date. But the calculation of compensation actually paid under the final rule requires a different amount to be included. So instead of using your grant date fair value, you essentially have to kind of revalue those instruments at the end of kind of each reporting period. So each year that you have to put this disclosure in all the way through, the vesting of that award. And so the purpose behind this is, again, they're saying we want you to remeasure this award, even though you don't have to do it for US GAAP. So this is a difference than what you would be in your financial statements, because we want to better align this compensation disclosure with when the award is actually earned by that executive. So, one thing we're telling clients, because we have this question come up quite a bit, they're looking at this and they're like, wait a minute, this isn't something we're doing. And we're like, yes, this is a significant change, especially if you have complex equity awards that under GAAP, you would normally just have to deal with fair valuing that equity classified award on the grant date, and then you just leave it alone unless you modify it. Here, you now have to do a recurring valuation exercise every time you need to prepare this disclosure. So they're having to potentially engage their valuation specialists and obviously just allow for the time and effort to essentially have a process to keep those equity awards kind of remeasured each time you need to prepare this disclosure.
Okay, let's go ahead and put a pin in the pay side of things and swing over to performance-related metrics included in this table. Walk me through some of those elements.
Yeah, so the first one we talked about was total shareholder return, or TSR. And again, that has to be included not only for the registrants of the company itself, but also its peer group. Total shareholder return, just definitionally, it's the same way it's defined in other SEC requirements, so in item 201E, but basically you're adding up, cumulative dividends plus the increase or decrease in the company's stock price for the year divided by the share price for the beginning of the year. Whether you're doing registrant or peer group TSR, they're essentially calculated the same way, but for peer group TSR, you normally will use like a weighted market capitalization at the beginning of the period just to kind of get your peer group. And then a lot of people ask like, well, how do we come up with our peer groups? Like what do we generally use for that? And so the peer group is generally for most registrants going to be based on the same peer group they're using for other SEC requirements. So item 201E again, or it could also be the peer group that you use to benchmark your kind of compensation disclosure and analysis in your proxy statement. So your CD&A. The next performance metric, net income, is exactly what it sounds like. It's net income. The SEC staff actually provided kind of a CD&I to help clarify that, hey, net income performance measure that you're going to put in this table needs to be net income from your audited GAAP financial statements. Like you shouldn't use other derivatives of net income. So you're not going to do net income or loss, attributable to the controlling interest or from continuing operations. It needs to actually just be net income.
Okay. Now, what about the last performance metric, a company selected measure? How is this determined? What are some things that we need to be thinking about there? Anything specifically we can't use or should?
No, that's a good question. It's supposed to be your most important financial performance measure, other than obviously net income and total shareholder return, because you're already including those that are used by the registrant to link the compensation paid for the most recent year to the company's performance. So this measure could be other US GAAP measures. You could have revenues or operating profits or maybe segment profits or something like that could be something that would be used, but it can also be a non-GAAP measure. So a lot of companies use EBITDA, obviously as a way to gauge performance. So EBITDA, adjusted net income, other derivatives of GAAP measures are also okay. One thing you want to keep in mind is if you use a non-GAAP measure, you should disclose how that number is calculated from the actual GAAP audited financial statements. So, users have an understanding of how that's derived.
Okay. Now, you also mentioned that the rule requires a tabular list of these performance measures. Is that completely separate from the PVP table?
Yeah, so it's separate from the table. So you're going to have your most primary kind of company selected measure in the table itself, but then kind of below that is a separate tabular list that's also supposed to include other kind of important financial performance metrics that are used to link pay versus performance. The list itself, like you don't have to rank them like, most important to least important, but really should just be kind of a general list. And the rule states it should be at least 3 measures up to 7 performance measures for the most recent fiscal year. Obviously, you need to include the measure that you included in your PVP table as being the most important in that list. But you can also have non-financial performance measures that are in this tabular list. So some people may also base pay on things that aren't derived from the financial statement. So it could be on more operational things like number of customers, number of data breaches, a number of other like metrics could be used. And you generally include that kind of additional language if you feel like any kind of financial performance metric that you included in that tabular list might be hard to follow, confusing, and you don't want to mislead people. And again, if you use a non-GAAP measure in that tabular list, you want to explain how it was derived from a GAAP number. So if you're going to use EBITDA, for example, as one of your kind of 3 to 7 top measurements, then just explaining like how that's derived.
Okay. So Adam, what if a registrant uses fewer than 3 performance measures to link executive pay to company performance? Is that even something that's allowed?
It is. I think the SEC has the viewpoint that most people likely will have more. But if that truly is the case, that you have 3 or less performance measures that are used as part of evaluating pay, then you probably, just include the 3 you have or the 2 you have, but you would need to kind of disclose that fact that these are the only measures we use. So I think one thing you got to keep in mind is if you include that in your tabular list here, you don't want to have conflicting things like maybe you're on an investor call and now all of a sudden you're talking about different things that aren't reflected in this tabular list that might be linked to pay. So just thinking about all the different areas where you're discussing compensation and making sure you're not speaking to things that aren't like kind of represented in this tabular list.
Yeah. So let's talk a little bit about the tabular list specifically. Okay. Anything that we need to be keeping in mind for how that information is presented?
So they give you 3 options to kind of think through. So one is kind of having one full list that has it for all of the named executive officers, including your principal executive officer. The second option is having 2 separate lists. So one separate for the principal executive officer and then one for the other named executive officers. And then the third one is like even more disaggregated, is one for obviously the principal executive officer and then for each named executive officer having a separate list, because there may be different metrics that are used depending on who the person is. So it may make sense depending on how a company actually kind of evaluates pay versus performance for each of those officers.
Okay. So lots of different options there. You also mentioned that the need for a description of the relationship between executive pay and performance. Expand to me a little bit on that and exactly what needs to be covered to essentially satisfy that requirement.
Yeah, so there's flexibility here. I mean, obviously the objective is to really provide context behind that relationship. So between what's actually paid as disclosed in that table with the registrant's total shareholder return, net income, and whatever that company's selected measure is. And they don't necessarily prescribe you have to have this long narrative, explanation. They give the option, like if it's better to be illustrated through graphics or charts or things like that, you can present it in a number of ways as long as you're kind of clearly providing kind of insight into how these different measures in relation to what they're getting paid is clear, right? There's transparency there. The information is useful for investors or other users of those filings to understand that relationship.
Okay. Now, earlier we mentioned that the new rule applies to proxy statements and information statements where executive compensation disclosures are required. Mm-hmm. Does it apply to any other filings within the SEC? For example, registration statements as part of an IPO, or even just a registrant's annual report?
It doesn't. So it won't apply to registration statements or annual reports. Again, it's really just proxy statements, so kind of Schedule 14A, and then other information statements that may also be filed where there's executive compensation disclosures required. So a lot of times you'll see that in a Schedule 14C. One thing about the disclosures is that registrants are kind of permitted to determine where they want to put them in each of those filings. So there's no necessarily prescribed way of like where they should actually go in that filing itself. So kind of a little judgment there to determine what's the best location. Generally, I would assume most registrants are probably going to include these new disclosures kind of in the section of where they would already talk about compensation discussion and analysis. There's kind of the CDNA part of the proxy or information statement.
Okay. Now, listen, I know we talked on a previous episode about XBRL. Do inline XBRL requirements apply to this new disclosure?
Yeah, they do. So the final rule will also require registrants. You got to separately tag each value in that PVP table, as well as the footnote disclosure, and then block text tag the footnote and relationships using inline XBRL. So subject to those requirements as well.
So we've just covered a lot of information, but earlier we mentioned SRCs have scaled down requirements under the new rule. What are some of the accommodations that they are afforded?
Yeah, so we talked about that, for example, that PVB table being kind of the largest component of the new disclosures, that being a 5-year table, obviously a lot of information. So SRCs are permitted an accommodation there. They only have to present 3. And even so, in the first filing where this kind of new rule will be required, SRCs are actually permitted if they decide to only provide 2 years of data, and then obviously this following year they could add the third, just to give them a little more like time, I guess, to get ready for the undertaking. But then in addition to just having a reduction in the number of years in that table, there's also several disclosures that we just kind of walk through that wouldn't actually be required for SRCs. So one, they don't have to present the cumulative total shareholder return for the company's peer group and the company's selected measure in that table. They can omit the kind of the description of those relationships between pay and performance that we talked about that you would have to do typically for a company selected measure and a company's total shareholder return and that peer group total shareholder return. They actually get to omit the tabular list, so they don't have to have the 3 to 7 metrics. Kind of talking about the other kind of important performance metrics that are used by the company. And then they actually can omit having to worry, and probably don't see this as often, but because fewer companies tend to have pensions, but like for purposes of calculating that total compensation paid and that pay versus performance table, like there's adjustments that have to be made to pension amounts. They're allowed to kind of omit those adjustments for pensions just because there's a lot of work that's required to ascertain those adjusted amounts.
So a lot of accommodations given to SRCs thus far. Anything else?
Yeah, I guess one more thing to tack on would just be just some accommodations as it relates to the XBRL kind of tagging requirements that we just talked about. There's a phased in kind of approach for SRCs, so they wouldn't have to actually tag this new disclosure until in the third filing where they're subject to the pay versus performance disclosures.
Okay, so when do those impacted SEC registrants need to start worrying about these disclosures? And what does a transition period, if any, look like?
So the disclosure requirements are effective for fiscal years ending, they said December 16, 22. So for calendar year end registrants that are within the scope, it's essentially going to be required in their 2023 proxy filing. So a lot of companies, you kind of get through the audit waves and, the early part of Q1, and then you naturally transition into your annual shareholder meetings. So you're preparing your proxy filings and things like that. That's when we're going to see the first wave of this. One kind of benefit, if you want to call it, and this is for non-SRC, so kind of just I call it your regular registrants, I guess. There is a little transition relief provided, especially in year one. If you think about a lot of companies taking this on and then they're thinking, oh crap, I've got 5 years of information I've got to kind of go back and track. They do provide for some transition relief where a company could use 3 years in its initial kind of disclosure instead of the 5. And then each additional year, they would just layer on that 4th and 5th year until they got to their kind of 5 years going forward. So there is some benefits that allow kind of non-SRCs that might be tackling this as part of their kind of proxy season, in preparing that information and getting it ready to go.
So great. But next question would then be, what about for newly public registrants? How does this new rule impact them? And, potentially what does the transition period look like there?
Yeah, so we talked about it's not required for registration statements. So as they're becoming public, they don't have to worry about it in that statement. But then to your point, if once they have IPO, they are now a public company. Couple things here to think about. Like one, if you are a newly public company and you qualify as an emerging growth company, you don't have to worry about the rule so long as you hold that status. But if you are a newly public registrant and you don't qualify as an emerging growth company, then you will be subject to the rule. But they do provide, again, some specific transition guidance for registrants under those circumstances. So newly public, non-EGC registrants only have to provide the pay versus performance disclosures for the years where they were considered a public reporting company. So basically the years where they actually had to file like a Form 10K with the SEC. So an example here would be, if a private company initiated its initial public offering in March of 2023, they would only be required in their 2024 proxy filing to include the year 2023 because it's the only year they actually were a public company. They wouldn't have to present prior periods where they actually weren't considered a public registrant. But then in subsequent years, so in their 2025 proxy statement, they would then kind of add on an additional year. So they'd have 23, 24, and then over time they would build up to where they have the full disclosure requirements of the 5 years.
Okay. Adam, I think this has been a interesting conversation. I think a lot of changes happening over the course of this year in 2023 and on around this pay versus performance topic. Anything else though that we want to leave with our listeners? Some last bit of advice or anything else?
Yeah, I guess because this is introducing potentially a lot of information that a company's not tracking, and we may have touched on it a little bit, but I think companies need to, and a lot probably already have in anticipation of this rule, just making sure they have the right processes and controls in place to provide the information that's necessary. Also thinking about, since these are kind of new compensation related disclosures, whether there's going to be required reviews by compensation committees and things like that, making sure they're kind of pulled into the fold here. And then, just thinking about how the registrant itself communicates executive compensation practices and making sure that, what you're saying in investor calls or presentations or what you may be doing kind of outside the disclosures aligns with whatever you do include ultimately in this disclosure. And there's kind of reconciliation of things and it makes sense. And you're not telling one story somewhere and then these disclosures are presenting something differently. You just want to make sure you've got consistency there.
Okay. Well, super helpful conversation, Adam. I know that our team here at Embark is prepared to help any of these companies out there that have any questions. And I'm sure you'll be the first one that they want to call. Listen, to our listeners, thanks so much for joining in around this discussion and the new SEC requirements around pay versus performance. Thanks so much for joining us, and we'll see you next time.